All right, there's been quite a few changes in the last few months, and particularly actually even in the last few weeks. The title that we had of our QEO this time was nearing the finishing line, because at that stage, a few weeks ago, we were anticipating that we were getting pretty close to rate cuts, but didn't necessarily expect them to start last week. So we got that wrong by 6 weeks. But to be fair, if I think about where we were 3 months ago, things have changed a lot. For the first half of this year, we hadn't changed an interest rate forecast. We were basically thinking that interest rates would stay at 5.5% for the year. The Reserve Bank had been even more hawkish than that. So we find ourselves now in a very different position. So it's interesting to think about why and also what's coming next. So pretty big changes last 3 months, as I said. Here's my first question of you, is what do you think the economy is going to do in the next 6 months, based off your kind of experience of how you think it kind of has gone in the last, say, 3 to 6 months? Do you think the GDP is going to be stronger? The economy is going to be stronger over the next 6 months, about the same, or perhaps be weaker? Well, the numbers are coming up pretty good. So we've got about 120 people there, and there seems to be a bias towards things remaining about the same, which is not fabulous news, because unfortunately, if I go forward to the next slide, things have really taken a bit of a dip in the last 3 months. And one bit of evidence you can see that something has certainly changed is just looking at what market interest rates have done, and the quite significant turnaround in the Reserve Bank's view just in the last 3 months. Basically we can see that interest rates have fallen a long way. Adrian Orr and his team have done a 180-degree turnaround. I know he's trying to be at pains to suggest that isn't the case, but I think that that's pretty much what has happened. They went from 3 months ago talking about putting rates up and certainly not putting them down until next year, to cutting them already. So whenever you see something like that go on, you mean there's probably a good reason for it. And the reason for it is that particularly the last 2 months, June especially, a lot of the indicators of activity in the economy took a real dive. And here's a selection of ones here that we have looked at, ranging from things like vehicle, kind of like transit activity on the roads. It's this ANZ truckometer. The purchasing manager indices went to very weak levels over May and June. And what's particularly interesting is that in the jobs market, firms have actually started to shed staff now, which is interesting because for most of the last year or so, even though the economy has been going sideways to slightly backwards, firms have still generally been happy to add staff. So that really has turned around in the last couple of months. Why is that? Well, I think that the thing that I think happened is that back in May, when the Reserve Bank told businesses and households that they didn't really expect there would be interest rate relief coming for a good while, that really did prompt adjustment, either in terms of spending habits or in terms of like business planning. And, because people realised that it maybe wouldn't be just 3 or 6 months to hold on, that it might be a year. As it turns out, that the relief has come a bit sooner, and that's a story for the future, I think, in terms that I'll talk to you a bit in a minute. But we certainly did see that sudden adjustment in the last few months, reflecting that, I think, that pessimism that it might take a while before we got a bit of interest rate relief. So how is that translated in terms of how we see the economy? Well, the most tangible sign of the weakness is really in terms of what we think happened to the economy in the second quarter of the year. We won't get that data for another month or so. Previously we'd thought that GDP would go backwards by a small amount, maybe -0.1 or -0.2%. We now think that it probably went backwards by about 0.6% in that quarter, which would be one of the weaker quarters we've seen outside of the COVID variability for quite a long time. And certainly something really noticeably different to this rolling mall recession that I'd sort of described the economy had been going through for 18 months, where we'd just had a string of GDP numbers that were zero plus or minus a little bit. So that's a real change. And because we think that the economy went backwards by minus 0.6 in Q2, we think it's probably pretty reasonable to expect it to go backwards again in Q3, where we're standing here and now. So that's been a decent markdown in our near-term growth outlook. The Reserve Bank similarly shared that view when they put out their MPS last week. In fact, their growth forecasts now look remarkably similar to ours if we think about the next 6 months. So, we've basically got a view probably a little bit more optimistic than the poll result, in the sense that we think things will get better in the next 6 months, but it's still going to be pretty weak for a while. And it's really getting towards the second half of next year, where I think we will see a meaningful bounce back, at least at an economy-wide level. I think some aspects of the economy might come back a bit sooner with the interest rate cuts. We basically think that growth next year is going to be about 2%. That is a bit lower than what we thought 3 months ago. And the year after that, we think it'll be closer to 2.5%, which is also a bit lower than the 3% odd growth that we'd expected back then. So generally, it's a weaker growth picture, which kind of makes sense when you look at what the interest rates have done, because the interest rates fell for a reason. From a cyclical perspective, we can see here that this is generally still a relatively shallow recessionary period, but it's much sharper in per capita terms because there has been that strong population growth in the last year. As I'll explain to you in a bit, though, our view about population growth has changed reasonably significantly, given the economy has changed. With respect to the global outlook, our forecasts for the global outlook haven't actually changed very much at all. There's certainly some changes in the distribution of growth around the world. That US economy, for example, continues to be relatively strong. There's a bit of strength in some of our Southeast Asian trading partners, but that Chinese economy continues to be weak. And increasingly, the data in China is probably starting to reflect the reality that's been there for a while, where the authorities, I think, are probably finally ready to admit that the 5% growth target that they have is not really going to be achievable right now. If I look in terms of how that's been reflected in the commodities that we sell the world, it doesn't look like things have actually changed very much, so we can basically see that for China especially, it's just a relatively weak consumer, which is meaning it's really capping the degree to which we get positivity out of commodity prices in the agri sector more generally. But the good news more generally across the world is that inflation is increasingly under control. So there's a whole string of advanced economy central banks that have already cut rates now we've joined them. The US is expected to start cutting rates next month, and may even have done a couple or 3 cuts by the end of the year. And that generally reflects the fact that across the world, as in New Zealand, inflation is now getting quite a bit closer to target than it has been for a while. Which is good news, and probably is ultimately going to start laying the foundation for better times for global growth if we think forward a year or two as those interest rates go down. With respect to the fiscal outlook, what do you reckon in terms of when we're going to see a budget surplus? Do you think that it'll be achieved by 2028 as the government has currently forecasted, or not? You tell me what you think and I'll tell you what we think. It's not encouraging for the minister, is it? Yeah, okay, well that's a fair call, that one. I would say the forecast for a surplus after 2028 is aspirational. I think that's probably a light way of saying it. Our view is a bit more negative on that. The problem we have right now is because this economy has come off, the revenue side of the income statement's looking pretty sick. And indeed, we won't get a formal update of the government accounts until the end of the year when they do the high FU, but we fully expect it to be a lot weaker than what they showed in the budget. And they'll probably have to increase the bond program to reflect that as well. They could be, 6 billion short, basically, in terms of expected revenue over the forecast horizon, at least. So what that means is we're still definitely in the period where the deficit's getting worse before it gets better. And it does mean that, if we think about how the economy is going to grow over the next few years, it's pretty hard to see a surplus, even sort of before 2030. In the absence of some fairly significant cost cutting, which probably isn't realistic to be expected beyond perhaps the next year or so. So our forecasts really deviate from Treasury's in the sense that we don't think that they'll be able to continue to cut baseline budgets by the sort of 6 or 7% type number they achieved in the last year beyond the next year or so. It just will get a bit hard. So, what that basically reveals is that we've got this quite significant structural deficit there that, in the absence of a relatively strong boom in GDP growth, means that we get fiscal deficits. And it also means that debt to GDP is going to probably struggle to fall, probably more likely stabilise above the government's target for net core crown debt, which they're aiming for 20 to 40. In our forecasts, it'll probably be closer to 45 over the forecast horizon. So we've certainly got one side of the quinella there in terms of the twin deficits, because that's one deficit that probably isn't going away for a while, even though we're going to have a fiscal policy that's going to be generally pretty tight, because if it wasn't tight, the numbers would be worse than this, and therefore a bit of a drag on growth for the foreseeable future. Labour market is another key driver. As I mentioned, the filled jobs has gone backwards, particularly in the last few months or so. So what's your view in terms of what the unemployment rate's going to do by the end of the year? Now, the June quarter was reported at 4.6%, which was fairly close to forecasts. Where we're going to finish the year? All right, so we've got, we certainly have a view here that there's going to be rises in the unemployment rate to sort of perhaps just above 5%, I think is what we've got sort of in the forecast. So that's kind of broadly consistent, I think, with what people see here. The reality is the labour market is one of the lagging kind of parts of the economy. When output starts declining, it takes a while before unemployment starts to rise. And what we would say is that, the labour market is currently eased quite considerably from where it was perhaps even 12 months ago, probably in easy territory. And that unemployment rate is going to track up to 5.6% over the course of the next year. As I said, it'll be around about 5.2% at the end of this year. It's not as steep a rise in the unemployment rate as we saw during the global financial crisis, where the economy took a much sharper dip. And it is sort of part of that, I think, that adjustment sort of that the Reserve Bank has been trying to engineer for a while in terms of trying to get inflation down. And one of the consequences will be that hopefully wage inflation decelerates quite a bit from what it has been. Because based off the statistics, at least we've seen so far at an aggregate level, wage inflation is still holding up. There is a bit of a split between what's been going on in the public and the private sector. Public sector wages are running much more strongly than private sector wages right now. But even in the private sector side, there's quite a bit of ground to cover before you get wage inflation back to 2% on an LCI basis, which is really where it needs to be if you think that overall inflation is going to be at 2%. So there's still a bit of adjustment to come here. The good news is that the adjustment that we expect in the labour market should ensure that happens, and the Reserve Bank certainly expressed more confidence that they expect that to happen going forward. The other thing, though, that has happened with this weaker labour market is it really has shifted around these net migration flows that we've been talking a lot about for the last year and a bit. We had historically strong inward migration, Now that's really turning around. We're past the peak now in terms of net migration. So there are fewer foreigners coming, but there's particularly a lot of New Zealanders leaving. And that is the normal kind of cycle that you should expect when we basically have a relatively weak labour market in New Zealand. So, the high profile number that everybody likes to ask me about is, what about all the Kiwis leaving to Australia? Well, we made a bit of a forecast of what we think that is going to do. You can obviously see that it's been picking up quite strongly. We've actually used Australian numbers to be able to work this out because they have actually better data on migration of New Zealanders than New Zealand does. But you can model this one quite nicely based off the relative unemployment rate, and the New Zealand unemployment rate's expected to be a bit higher than Australian unemployment over the next couple of years, which is unusual because usually it's the other way around. As a result, we would expect to see ongoing outflows of New Zealanders for the foreseeable future until that labour market starts to strengthen, perhaps sort of like later next year or thereafter. The implication of all this, though, is that we've really made an adjustment to our assumptions for population growth in our forecasts. Population growth was historically strong and a relative support to GDP growth in the last year. In the absence of it, I think we probably would have had even weaker growth than what we currently saw, and probably lower interest rates a long time before now. Because we would have had a lower inflation earlier as well. Well, that cycle is going to turn. We've adjusted that view. We think we're going to go from sort of the 3% annual population growth down to 0.4 at the bottom. And that is an important reason why those growth forecasts that we have for next year and the year after are a bit weaker, because it is being driven to some extent by what we think population growth will do. Ultimately, population growth will recover because the economy will move back to trend again. The labour market will stop easing, unemployment rate will ultimately fall. But that's a story for sort of 2 or 3 years down the track as opposed to now. For households and consumers, it's still going to be fairly tight times. Household spending has been very weak in the last few months. We would expect that to continue for a bit longer than we previously thought, before picking up maybe once we're getting through to the back half of next year. Although it is an area of risk in the forecast now, given the Reserve Bank has moved a bit earlier, the reality is that things like consumption spending is quite related to house price changes, and house price changes are quite related to changes in interest rates. So there is a bit more two-sided risk, I think, around these forecasts than there has been for a while. So in terms of interest rates, we've got this falling interest rate cycle now. You've seen the mortgage rates start to move down. They've, the 2 and 3 year rates are now lurking sort of like in the high fives. If I do a back of the envelope calculation based off typical spreads about where they're going to end up based off our forecasts, I'd say that somewhere in the sort of fives is where they're ultimately going to end up. I'm sorry if you want to have your 3-point-something mortgage rate again, but if you get it, it will be because something very horrible has happened to the economy and you may have lost your job. So you probably shouldn't be hoping for that. In the housing market, it's pretty weak right now. We actually got some slightly better data yesterday, I suppose, which I didn't update on the chart, but at least sales picked up quite a bit in July relative to a really weak reading in June. Prices are still going backwards though. It's probably going to be closer to the springtime and the summer before we see these interest rates potentially impact on house prices. Certainly for now, we're basically expecting house prices to go pretty much sideways, start picking up as we get through to the back end of this year and next year. I reckon this is an area where there could be some upside risk for house prices based off what's going on with interest rates. So, we're certainly watching this data for the next 3 or 4 months, and I think the Reserve Bank is as well, to sort of gauge just how responsive this economy is going to be to the interest rate cutting cycle that's now underway. After that, we anticipate that for 2025, we'll have around 6% house price growth, dropping back to 4% the year after, and that's related to that population cycle that I was talking about before. Tends to be about a 1 year sort of like lag, I guess, between population growth and house prices. So the weaker population growth that we're expecting through 2025 should be increasingly be felt in house prices in 2026. All else equal, and the reality is all else is very unlikely to be equal, I think, over the next 6 to 12 months. The business sector, it's pretty down there as well. There's a whole host of indicators I could point you at to show just how poor sentiment is in the business sector. This PMI index gives you a bit of a sense of that, though. Some of these indicators look as weak as they were in the GFC. There has been some signs of a bounce back in the most recent monthly data that's come out in the last week or so. I think we would anticipate these to come back over the next few months or so. The biggest, I think, question we'll have is the extent of the bounce back. The Reserve Bank will be looking at that as well to gauge, is a gentle easing cycle going to be appropriate, or are they going to have to go a bit harder? And with respect to business profitability, all of those indicators are currently very weak, and we would normally expect that to be associated with a relatively weak investment outlook, which we've got in the forecasts as well. If businesses aren't making money, they're probably not investing very much. They're probably pulling back. Primary sector, probably a slightly better story. We haven't changed our milk price forecasts in the last few months, really. We're still sitting at about $8.40. We got a really good GDT auction this morning, really good, best one that we've seen since 2022. And truth be told, there's probably a decent amount of upside risk now in our milk price forecasts. But I am conscious these prices have been quite variable. The exchange rate has ticked up a bit as well. So we'll see how this settles over the next sort of few weeks. Fonterra should be due to give us a bit of an update on their milk price expectations, which are currently still sitting down at $8. But it's like I said before, though, even though that Chinese economy is still weak, they still are buying things. And I think, in my view, is that a lot of the weaker data we're seeing coming out of China is more just reflecting the reality that's been there for a while, as opposed to something that's particularly changing now. I think that Chinese economy is probably a 3 or 4% economy, even though the authorities would like to pretend that it's a 5 or 6% economy. The general view on commodity prices is still fairly muted. We're basically expecting steady recovery, but nothing particularly spectacular in most of the classes of commodities. It's all quite leveraged, I think, to the global economic cycle, and in our forecast, we don't have very much in there right now in terms of improvement in global output. But now this interest rate cycle has started to move down globally. Perhaps there's some potential for better times there coming out of the external sector. And we sure as heck need it. The second leg of the quinella, in terms of the twin deficits, is the current account deficit, and we've certainly got that one too. We're still importing quite a lot relative to what you would hope we would be importing if we were going to have a better balanced current account. So you can see there that we're still down at, I think, 6.4% of GDP in terms of a deficit. We expect it to narrow, but not really beyond about 4% to about a deficit of 4% of GDP. So we've got that big fiscal deficit. We've got a pretty decent sized current account deficit. Most of these things add up to a bit of risk, particularly around the exchange rate as we go forward. So getting down to the crunchy bit, what's going to happen to inflation? Question I've got for you this time is, what do you reckon the low point for annual inflation is likely to be over the coming years? I'm being deliberately vague here because you might have a different horizon, but where do you reckon it'll get down to? Is it going to be above 2, around 2, or noticeably below 2? Bearing in mind that my Reserve Bank is supposed to be targeting 2 as a midpoint. All right. I share your pessimism, actually. We've got in our forecasts the inflation rate falling towards 2, and I think it does touch it briefly. But I think in reality, what we're more likely to see is it just holding up a little bit in general over the next year or so. The biggest problem, I think, is that there's a real bipolar sort of trends going on within the CPI right now. We've got very strong non-tradables inflation, all the domestic services sector inflation. Now, there's some high-profile things like rates and insurance in there, but actually just about everything else is also running substantially stronger than really where it would be if we were going back to 2%. And that's really holding up inflation, but what's been on the other side of it is we've had very weak imported good inflation. And that's what's really managed to drive the CPI down as far as it has. Now, the crunch there, though, is that typically when we analyse these things over the medium term, you don't really rely on perennially weak tradable inflation to get you to target. You really more rely on driving the domestic kind of generated inflation back to something close to 3 so that you can average out at around 2. And our view is that that's going to take a while. And I would say that's probably the biggest deviation between our forecasts of inflation and the Reserve Banks they presented last week. They've become suddenly much more optimistic that pricing behaviour is going to normalise quite soon. And frankly, there's not really any evidence in support of it. In the actual data we've seen so far, they've taken that on faith. So we're going to have to just see how that rolls over the next 6 months to see, the extent to which that confidence is well placed. Monetary policy. Where do you think the OCR is going to end the year? 2 more meetings to go, assuming they don't do an emergency rate cut somewhere. Market was quite excited about the possibility of an emergency rate cut in the US a couple of weeks ago. Idiots. Very good. So somewhere between 5 and 4.75%, which is like 1 or 2 cuts. And, that is interesting because the markets are much more ambitious in terms of what's really likely to happen. Our forecasts are that we get 2 more before Christmas, 25-point cuts in October and November. Now, I think we could probably have reasonable assurance that at least between now and Christmas, the Reserve Bank's going to keep cutting. They've really done a big sudden change in direction here, and I think it would take an awful lot for them to really turn that around anytime soon. And possibly the risks are biased towards a slightly faster pace of cutting than we have in our forecasts if, for example, some of those output indicators that I talked about don't pick up substantially in the next, say, 3 or 4 months. That might bring into play the possibility of a 50 basis point cut in November just before Christmas. But for now, I retain an optimistic view here that the economy will respond to this changed interest rate environment. I think that much of what we saw in the last few months reflected that very hawkish stance the Reserve Bank took back in May, and that is gone now. So we will see basically exactly how that rolls out. Beyond that, I think that what we're basically going to see is a relatively front-loaded easing cycle that slows down once we get into next year. So, after the February monetary policy statement, the view is that they'll continue to cut rates at a measured pace at each monetary policy statement as opposed to every meeting. So the result is that it brings forward when we think we're going to get the OCR to what we believe is the sort of terminal level or the neutral level of 3.75% by the end of next year. Back in May, I would have been suggesting that was going to take perhaps a year longer, or six months to a year longer. So essentially what we've done is just brought forward the profile that we previously expected. Markets, as you can see on that line there, much more optimistic, right? They're thinking that interest rates could go down perhaps a lot more even in the short term. Imre is going to have a bit to say about that in a bit, and end up perhaps closer to 2.6 or 2.8%. That's not really what I see right now based off what we think the inflation dynamics are going to do. Why has this happened? Well, all those negative output indicators we saw have panicked the Reserve Bank into really adjusting their view about how much excess capacity there is in the economy. So they really shifted down this kind of concept of the output gap, which is basically the difference between the amount of activity in the economy and its potential, such that they think that there's going to be more disinflation over the next year or so than they previously thought. My picture there doesn't show that up very well, but like they've basically just adjusted themselves from in May, they thought that they were probably about as pessimistic in terms of they thought that there was going to be not very much excess capacity over the next year or so, now to the point where they're probably, well, they've got about as weaker, a weaker degree of excess capacity than they've thought probably for the last 18 months or so. But what's really changed is that they've markedly changed their view about how fast interest rates can fall. So they actually still think that interest rates are going to end up at about the same place that they've thought for a while, but basically around 3%, 2.75%. But what they've really done is front-loaded the easing and made it happen more quickly. And they've taken themselves from a position where they are as hawkish as they had been in May in the last couple of years to now way more dovish than they have been for a while. So that's a pretty big change in view. I would call that a U-turn. The governor perhaps wouldn't. And as I mentioned to you before, the key to giving them the confidence that they can do that is this idea that non-tradables, domestically generated inflation is going to disappear quite quickly and normalise. And as I said, that's not something we've actually seen in the data so far, and it'll have to be something that we watch as we go through this next 6 months. If they get a bit disappointed on that score, then maybe they'll pin things back a bit in terms of what they do next year. I would suggest to you that the bank has a much clearer idea about what they're doing between now and Christmas than what they might be doing next year. And indeed, our experience of the last 3 months suggests that medium-term forecasts of interest rates issued by the Reserve Bank are not really promises. They're indicative at best, perhaps not even that. The other thing is that New Zealanders are actually very well placed to take advantage of this easing cycle when it's coming. Most New Zealanders seem to have adopted the view that interest rates weren't going to stay up at these levels for very long, so they tended to roll their mortgages quite short. So we've got about, I think, 46% of mortgages repricing in the next 6 months. So now these mortgage rates have gone down, they should flow into the bloodstream of the economy pretty quickly, which is the opposite to what we saw in the tightening cycle where everybody had gone relatively long duration and it took a while for those interest rate hikes to flow through. So that's another reason why I think you can probably have a degree of optimism about how the economy might pan out in the next 6 months or so. Exchange rates, last one. Where do you think Kiwi US is going in a year? Higher, lower, or about the same? All right, what have we got? About the same. Good bet. I haven't got any idea either, really. Imre thinks he knows. Yeah, so the exchange rate's been fairly stable now for quite a long time, right? That range that I put down there pretty much describes what's been happening for a year or so. And the thing about the Kiwi US exchange rate is that it matters at least as much about what happens on the US side of that equation rather than the New Zealand side. So we do have a forecast that now that the Fed is starting to cut rates from next month, that the US dollar will gradually weaken, and as a result the Kiwi US will rise. However, taking you back to that twin deficit story, where we have a high current account deficit, a high fiscal deficit, and frankly a pretty weak growth outlook and declining interest rates, that's not a cocktail that should suggest that we get a very strong exchange rate for the foreseeable future. So underlying our forecast is relative weakness in the New Zealand dollar against most of our trading partners. So the TWI is expected to depreciate, and a couple of particularly high-profile currency pairs, like the Kiwi Aussie rate, is expected to track on down towards 87, 88, and Kiwi yen in particular is expected to depreciate quite significantly. I would do that skiing holiday in Japan this year. So with that in mind, that's the economic view, and Imre, I believe, has some perspectives on the markets that he would share.
Thanks, Kelly, and that's quite a good disclaimer that you touched on. There are those who know they don't know and those who don't know they don't know, so you decide which one I fall into, but we always have a crack. That's what they pay us for. Okay, so the forecasts for the exchange rates for the next few months, higher against the US and lower against Aussie. And I'll explain the rationale in a second. Interest rates lower, whether it's long or short term, and the yield curve shape will continue to steepen, i.e. longer rates will rise more than, or rather shorter rates will fall faster than longer term rates. Okay. And on to the substantiation, starting with the Kiwi US price behaviour over the last quarter. We always look back at the last quarter when I stood up here and said this would happen. Did it actually happen? Partially. I'll give myself about a half pass for that one. We thought it would go up to about 62, and so it did for about the first month, and then it plopped back down again. A good chunk of that fall back down again was related to the Reserve Bank's surprising U-turn. They flagged that in July, and they actually enacted it last week. Both big surprises to the market. So that was a big explanation of that. Looking ahead for the next quarter, going again, same, up 62. And for the practitioners of voodoo who look at charts like this, they'll be getting quite excited because it's actually a wee bit higher than that now. In the last 2 days, it's actually accelerated higher as we speak. It's about 61.5, so it's getting up to that mark. 62, I think, is a risk of breaking. If 62 breaks, then you can talk about 63.5. So those are my current numbers. The voodoo practitioners, also known as chartists, will be thinking of even higher. People have been talking about 64, 65, 66s, but that's getting ahead of yourself. I think if you just kind of watch the price action, if you see 62 break, I think you've got a pretty good signal that it's going to go at least a couple of cents higher. Why? Because the US dollar has been weakening and we think it will continue to weaken. Red line's a depiction of the broad US dollar. There's no New Zealand stuff in there. It's just the US against some other GTN currencies. So it's a good broad representation of the US dollar, and you can see clearly it has fallen the last few months. Why is it falling? Two main reasons. One, as Kelly touched on, the Fed's going to start cutting rates in September, and the markets are quite G'd up about this, and they've priced in lots of cuts in the US, just like they have here. That has weakened the US dollar. Secondly, risk sentiment very recently has actually noticeably improved from a bit of turmoil in the markets early August, late July. Things have calmed down. There seems to be a bit less geopolitical risks, and equities are roaring ahead. So stronger risk sentiment hurts the US dollar. A second reason why the Kiwi has recently gone up, and we think those trends will continue. For the last few quarters, I've been standing up here and saying that yield spreads have been a really big influence on the Kiwi US, and that certainly was true, but the influence is now waning. I think as we now approach the point where markets have arguably fully, or even more than fully, priced the RBNZ cycle, it's just not such a big deal. And you can see that the Kiwi US in the black line isn't correlating over the last month or so as well as it normally has done over the last year. So I think yield spreads, although on their own they are a negative for the Kiwi, I think they're now less influential. In addition, risk sentiment, which has been fairly uninfluential, or non-influential, have become now influential, and they're kind of taking over. And we've seen this really just in the last 3 or 4 weeks where that risk mood has picked up. That's just one proxy of it. The US equity markets, you can pick other proxies as well. They're all done the same thing. Measures of volatility and risk have subsided. So the market mood is now more positive, and that's another reason why the Kiwi US has benefited. So yeah, pretty bullish story for the near term for Kiwi US. Kiwi Aussie, different story altogether. 3 months ago, we called it higher, and it did initially, so again, maybe a half pass mark for that one. It plopped back down again, and much of that was to do with the New Zealand easing story being priced in against the Aussie story being priced the other way. They've had some good economic news. Their RBA is actually slightly hawkish, and they've been muttering about if they had to, they'd hike rates. So they're in a completely different boat to the RBNZ. Markets have priced that in. For this cross, Kiwi Aussie, yield spreads really do matter. They've always mattered, they'll continue to matter, and we think yield spreads could go even lower. Right now, there's now no New Zealand yield advantage over Australian rates. They're about the same. The yield difference is about zero, and if the RBA maintains its hawkish stance, that could go even lower. We could go negative against the Aussie. But right here and now, the markets are seeing RBA in a hawkish camp, RBNZ in a fairly aggressive dovish camp, and we'll just keep selling Kiwi against the Aussie. So yeah, we've got that going down to, I think, about 89 over the next month or two. Interest rates have fallen quite sharply, particularly over the last few weeks. They've really accelerated lower. We did get the direction right, got the magnitude well and truly wrong. We were expecting these rate cuts to start a bit later than last week, but certainly they did. And the RBNZ, by the way, flagged this in its July one-page statement. That was a real shocker to the markets. We had to read it 3 times to make sure we were reading the right words, because up till then they've been talking about hiking rates. So big shock to the markets. From here, things look a bit stretched and overdone. So I'm picking a period of roughly sideways movement in swap rates, but eventually a resumption of the decline to a little bit further. Why this consolidation or stalling over the next month or so? Because market pricing is very, very stretched by most measures. So this one shows you in the black line what is market pricing. This is the traded market for OIS swaps. That black line is essentially a set of predictions of the OCR rate at future meeting dates. And you can see there's about 200 basis points reduction predicted for the next year. That seems a bit of a stretch. In addition, they're calling the low in the OCR to be around 2 3/4. So quite a lot below the Westpac forecast and even below the relatively dovish RBNZ forecast, as you can see. Why is the market so aggressive? Well, two things. They've been betting on these rate cuts for quite a long time. They've been in and out. So sometimes they've been in, it's gone against them. They've had to bail out a number of times. Eventually, though, they got it right. This has been a great trade for them. They've made a lot of money. So they're incentivized to keep riding that train a little bit longer. The other thing is the lurch in the Reserve Bank was quite shocking, really. So if you look at the blue lines, the thick blue line is where we are now. That's where the Reserve Bank's latest OCR forecast is. Prior to that, go back to February, we had the dotted line. And then in May, they actually pushed it higher. So they said the OCR can actually go up. And that was a bit of a surprise at the time. And then in May, they said no. In August, they said no, we're going the other way, and dropped it considerably. That's a really big fall in the OCR track, by the way. That's about the largest you've seen since the GFC. So really big shift by the Reserve Bank. That took the markets by big surprise, and that's partly why they are priced so aggressively for more rate cuts. So given that, it does mean, however, that swap rates are cheap. Cheap. Relative to what? Well, cheap relative to the OCR forecast that Kelly just outlined. If you converted that to term swap rates and lined them up, Kelly's ones are the ones in red, the market's in grey. All swap rates are cheap. Does that mean they won't go any lower? Yes and no. They could go lower. One thing to bear in mind, and this is going to be my last picture, is that look back at the past easing cycles. Ever since the OCR started in 1999, we've had 6 of them. And you can see that on every occasion, the 2-year swap rate, where did it bottom out? It bottomed out above or around the terminal. The terminal is like the final OCR rate. It never actually undershot below it. Okay, so if you can get the terminal OCR prediction right, I think you've got a good sort of sense of where these 2-year swap rates might bottom out. They'll be somewhere, if you take Kelly's one, 3 3/4, that would suggest that the swap rate should bottom out somewhere above 3 3/4. And we did that a couple of days ago. So you would say the bottom's in. If, however, you took, say, the Reserve Bank's own forecast for the terminal rate, which on that previous slide showed you was around about 3%, you would say somewhere above 3 it should bottom. Another indication is if you look at forward market pricing for swaps. So right here and now, in the traded market, they are showing a 2-year swap rate starting in 1 year's time to be 3.25%. And that's as low as the whole forward term structure gets. So the market's essentially saying that the 2-year swap rate's not going to get any lower than 3.75. So right now they're about 3.8, 3.85. There's potential to fall another 50 or 60 beeps, maybe, but that's it. So I think we're getting pretty close to the point where, people considering hedging or putting on fixed loans and things are getting to a point where things are looking quite attractive. So I'll close it off there. Thank you.